Well, here we are, folks. Tuesday evening once again. Boy, they come around quickly, don't they? Nice to see you on in the pre-show chat. And we've had a few interesting conversations about property prices, the Reserve Bank. We'll talk about the Reserve Bank shortly, and a few other things too. So very, very interesting times. And Damian, of course, will be coming in shortly. Here is the view of the studio. Damian is queued up, ready to come in. You can see him over there. We've got the multi-view. We've got the chat working. I think everything's doing what it should do. And of course, the doggies are here. They've had their walk and hopefully they've done their barking. We had the bins collected early, so hopefully it'll be quiet, but who knows? They do have a tendency occasionally to stir, so hopefully we will have a little bit of quiet. But they look quite quiescent at the moment, which is good. Anyway, we're just ticking down to 8 p.m. now, so it's good to take the pre-show off. I'm then going to start the show. I'll be back in just a moment. Well, good evening and welcome to this live stream on the 3rd of February, 2026. I don't know where the time is going. It's Martin North here from Digital Finance Analytics. Great to have you with us this evening. Thanks for taking some of your Tuesday evening out to share it with us. Really appreciate it. Going to have a really fascinating conversation with Damian about all things to do with the markets. We're going to cover gold and silver, the RBA. We'll also talk about some of the most recent results and a few other things too. So there's a lot to get through this evening. Before I bring him in, let me just remind you, as I always do, that we're not providing specific financial advice or legal advice, or it's a general conversation only. Please play nice in the chat. We moderate it, but feel free to throw your questions, comments, suggestions as we go. If you use if you use @Walk the World DFA, that'll get my attention and get your question into my queue. I've enabled Super Chat, which means you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate all those who support us, whether it's via Super Chat, Patreon, or PayPal. Really makes a great difference, and we really appreciate all of those who support us through those various channels. It allows us to keep going, which is terrific. So thank you for your help there. Right, let me bring Damian straight in. Damian, welcome back. How are you doing?
Not too bad. Yourself, Martin?
Yeah, pretty good. A few things to talk about tonight, right? It's been a fair old few days. I keep writing stuff and then things change. I was doing some stuff on precious metals and things change. So I don't know. We just take it as it goes, I suppose.
Well, I think we could, it's been a month since we last talked, but I think if we speak about just what's happened in the last 3 or 4 days, I think that's probably enough to cover the entire thing, and some of the stuff that happened before that doesn't matter anymore because of what happened in the last 3 or 4 days. So,
well, that's right, exactly right. Maybe goldfish have an advantage because they don't have to go back too far; they just go around the
fishbowl again. Yes, but we haven't made it around the fishbowl, Martin. We've just made it halfway across the front.
Yes, exactly right. I've got a very nice little castle down the bottom, around the corner. Now, let's start with the RBA. So, of course, the RBA did actually put rates up. And it's worth just sort of going through this in a little bit of detail. So 3.85% is now the new cash rate. They did actually say that while inflation dropped significantly from 2022, and it's gone up a bit, and they're talking about capacity pressures. They're talking about implicitly, I guess, productivity, and I guess they're also, without wanting to say it, is saying, well, the government actually is also spending quite a lot too. And so they talked about the contention between the public and the private sector and how net momentum was pretty capped out. And that's why inflation looks sticky. They went on to say that, there are some indicators that suggest the labour market remains tight. Unemployment is a little down. Labour utilisation is at low rates. Labour underutilisation, I should say, is at low rates. And they talked about the uncertainty. So they're still talking about a lot of uncertainty, capacity pressures, blah, 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 blah. So decision was, yes, rates will go up. They're going to continue to not give any forward guidance. They're going to continue to look at what's going on. Now, one of the things I always want to come to here is, of course, they take the market rates about future interest rates and plug that into their scenario modeling. which is interesting. So it's a bit of a circular argument in my view. And it's worth noting that Richard Holden said 2 rooted causes: the board didn't raise rates nearly enough, and Jim Chalmers has been spending too much. They've both messed up big time. So why is it hard for Bullock to say so? Interesting question. Alex Joyner said they've raised interest rates to 3.85%. Inflationary pressures picked up materially in the second half of 2025. Risk of inflation like to remain above target for some time. No commitment to a follow-up rate cut, but it's clearly the risk. Whereas Chris Richardson said facts have changed, so they've changed their mind. And I will just show you these 2 charts here. So the inflation trajectory says inflation's going to go up and stay, well, until about 2028, really. And the unemployment rate, well, it's gone up a little, but not dramatically. So I don't know what you make of this, Damian, but to my mind, the RBA has probably not dealt with inflation very effectively because they've tried to keep the employment benefits. And that means that we're struggling with this pain for longer. And I'm not sure that they're actually being totally transparent about the reasons for some of those things.
No, that's right. Look, I tend to worry about inflation when you have a wage growth, when wage growth's really high. I think we've got wages growing at like 3 or 4%, 3.5. I think it was the last reading we've got.
Yeah, it came back just a little from where it was, but it's still pretty strong.
Well,
split between the public and the private sector, right? Public sector wages growth is very strong. Private sector wages growth a lot weaker.
Yeah, exactly. And so, inflation's what, 3, bit over 3 as well. So we're not. It's not like we're wildly above. I guess I'm just sort of like, I'm worried when wage growth is like, when we're printing wage growth of, real wage growth of 2%. I'm like, okay, so now we've got, and if we've got inflation as well, it's like, okay, if there's things are running hot, what do we need to, other things to worry about? In my mind, if you've got inflation running at 2.5%, you've got productivity growth of 1%, and you've got wage growth of 3.5%, that sounds like a pretty decent economy to me. And so if you're going, look, we're worried inflation, that wage growth's 3.5%, and that's driving inflation of 3.1%. I'm like, really? Is that so? Okay, so from that perspective, I don't see that this is a wage-driven inflation market. And despite their sort of focus on unemployment, I'm like, well, I don't think it's wages that's driving. I do think it's all the other factors that are going into it. The high rates of immigration, the energy prices. There hasn't been lots of structural reform. It's right in terms of we've got public sector wages going up by more than private sector wages, which is in a way a sign that private sector wages are basically doing inflation, and public sector wages is what's driving it up. And so is that going to create some extra inflation if you're running public sector wages at 4% while private sector's at 3%? Yeah, that's probably a bit of extra inflation from that. And so I sort of feel the RBA hasn't got a lot of control over what it's trying to do. Like it's trying to raise interest rates to, I guess, in a way, hopefully cut off the housing market a bit, which might slow the economy down and bring inflation back a bit. But the inflation they've got is in my mind largely government policy, and so hard to control with interest rates is where I'm taking it. Having said that, do I think they're going to go again? Yeah, it's pretty rare they ever do a one and done. I think you'd need some relatively shocking data for them to do it, and more so the fact that it was unanimous this time around, that they're all rowing the boat in the same direction. Seems to be you'd expect at least another one at some point, and then you can sort of, the data's changed now and we can do an about face. But I sort of feel like if you do one and then stop, it's sort of it's almost an admission of error, and so it's
in the press conference, one of the journalists asked a cheeky question. He said, "Look, I've looked back over recent years, and actually, you've only been holding inflation within the band 8 decision points over 40." And he said, "If you were a team, playing football with that result, would you change the team?"
Yeah, it's interesting, isn't it? Well, I think that's probably slightly unfair in terms of that, in terms of the,
Well, we had
but
COVID, and then we were well under, and then we were well
yeah,
over, and that's what Bullock said in response. But it makes the point,
mm,
this
mm,
targeting of a specific inflation rate with so many variables going on around it is not straightforward, particularly if you don't want to actually tackle a lot of the. I mean, the productivity issue it's got to be solved, because without that, we're always going to be hitting the constraints in the economy. We've also got, of
mm,
course, the momentum in credit. So credit for investment properties in particular is very strong at the moment, and that's putting more momentum into that sector of the market, and therefore,
mm,
she's, I think, a bit concerned about credit growth and some of the stuff there. Now, in the statement of
yep,
monetary policy, they were very clear to say there are a lot of people who are doing fine, and they're actually paying back more than the minimum on their mortgages.
mm,
But then she did say, yeah, there are some actually, more caught. So, yeah, tricky times. But this issue, I just want to cycle back. This issue on they are making their baseline model off what the markets are saying rates are going to do, right? And
yes,
then
yeah.
the markets are going to actually calibrate where they're going to actually take expectations of rates based on what the RBA says. Now, that feels to me like one of those nasty, nasty feedback loops.
Yeah, exactly. And it keeps going in the same direction until suddenly it doesn't, and you get some big jumps in it. Look, um, yeah, I get that. But I guess in a way, there's also the point that yeah. So there's definitely some feedback loops in that sense that yeah, one's telling the other one what to do and reinforcing and like that. But also though, uh, there's some benefit in that it's a big weighted bet on the Australian economy that a whole bunch of investment houses are doing, and global investors, local investors, all sort of doing all sort of making these bets. And so do you end up with a reasonable inflation rate? Sorry, a reasonable estimate of what the inflation rate's going to be, and based on people trying to make money out of it. Yeah, it's a pretty good um, way at least of meaning that if the RBA is getting it wrong and markets are just are completely disbelieving what they're doing, it's a discipline to bring the RBA back and sort of reflect more what I guess people with money and skin in the game are saying around that. So.
Yeah, and we'll get on to the question of central banks and Walsh a bit later down the show, right? Because I think there's some really interesting conversations there. But
There is
we
a
should,
lot happening in markets.
yeah.
Yeah.
But I made a show the other day talking about enough already. Markets see a year's turmoil in a month, right? Because it's been quite chaotic in recent times, and I guess the nexus of that, certainly over the last few hours and days, has been gold and silver. And so maybe we should just spend a little bit of time on that particular dynamic first, because I do think it's fascinating. Now, things move around. So this is the latest gold price, and you can see that this is in US dollars. It was up above 5,500, nearly 5,600, dropped significantly down to 4,600, and now it's up 4,935. And if you were to look at silver, it's a somewhat similar trajectory, although it's dropped further, and it's now at 86. So, what's your take on all this? And one of the things that I find quite interesting is that there is pictures of queues outside the bullion place in the centre of Sydney, right? As retail people are buying gold because they think, well, it's dropped from there to there, so it must be good value. Um, it's a little bit more complicated in my view, and if you're building wealth for the long term, how does this play into it? And that's one of the things I really wanted to explore today a bit.
Yeah, so I think we spoke. It's hard to remember whether it was last month or the month before, or just about the gold. I think it
Mm.
was last month actually. We ran through some of the gold, um, and about how everything was sort of all pushing in the same direction all at the same time, and so that is my main concern on the gold front is that there was a whole bunch of factors that we had that were talking about saying, yeah, central banks are all out there buying, investors are all out there buying, issues with uh, the breakdown of geopolitical and things like that, worries about sound money, just all these factors all sort of flowing into the same part. And one of the big ones we threw up was that foreign reserves now of countries, there's more now in gold than what there was in what there is in US Treasuries.
Mm.
And so there's that idea that okay, there's this real demand from central banks out there, and initially it was sort of all the Russia getting kicked out of the financial system back at the Ukraine war, and so sort of people sort of sitting outside the outside that to trying to get in, and then it turned into actually there's a whole bunch of more countries now. So people like Brazil or things like that who are notionally friendly with the US, but all of a sudden they've got the US president attacking them and throwing tariffs and all that type of stuff, and just that whole idea about well maybe we don't need as much in US dollars. So that's sort of all pushing the same direction. Um, it's worth noting that within the US, within gold, it's about 40% sort of jewelry that goes into is where it goes. Maybe 5% industrial, and the rest is all investment. So more than 50% of what goes on in the gold market is investment for and so that's of what we're digging. So we're basically digging it up of the ground, out of the ground, refining it, turning it into gold, and then burying it somewhere else so that an investor can say that's mine in a vault somewhere. Silver's a bit different. So silver's so that's yeah. So that sort of gives you the gold part. The silver part then is actually way more actual use. So about 2/3 of it goes into industrial use. There's about another, less than 20% goes into investment. You've got jewelry and photography and, silver spoons and all that type of stuff that sort of make up the balance of it. But, you sort of got close to 80% of it being used for, or sorry, over 80% being used for actual things that people are using silver for, as opposed to just buying it as an investment class. So it's got sort of positives and negatives from that front. If you're an investor trying to play in that market, one is one of your big sort of negatives is sorry, both negative and positive is what investors do will make a bigger difference because there's just less silver out there for them to play with. When 50 or 60% of the market is all investors trading back and forth amongst each other, and you get some more interest, it's like, okay, so we've attracted 5% more investors, it'll push the price up a little bit. But when you've only got less than 20% to start with, and you attract another 5% more investors, well, all of a sudden the actual demand for that it can really make a difference to the overall use of that. So the silver's sort of interesting as well, in that the grain of truth behind silver is that you go, it's used in solar panels. And so because it's got this solar panel use and it's got the green technology and all that type of stuff like that, therefore it's got this huge demand that's going to keep lifting it and all this. And when you look at it, you go, it's just such a small amount. So if you look at how much solar panels have grown by in the last decade, we've just increased dramatically the amount of solar panels that are being done. It's been sort of 1% or less extra silver you've needed every year for the last decade. So less than 10% extra silver you've needed for that. So yeah, it's sort of everything helps, but really it's just not that much that's going into it. And so even if you doubled it again in terms of the amount of silver that you need, you could, and you lost, half your investors. That's enough without even increasing production. So, and the bigger issue for all these is that what does it take to get silver out of the ground? Now, it used to be sort of $20 ish, $22. You look at all the big mines. They'll look at most projects around that are profitable. They're making decent returns on it, and they're like, yeah, okay, if I can get $22 per ounce of silver, I'll invest in this mine. At 30, most of them are wildly investable. We're sitting what at 90 today, and we hit almost 120. So basically, any silver mine out there is, and there's more than enough silver sitting in these mines to do it. So, if you said, okay, over a 10-year period, if silver miners knew that the silver price was going to stay where it is today, they'd probably double or triple, quadruple the amount of production we've got of silver. Like there's just that's current prices are very much high enough. The problem is that it's going to take you, well, even if you're pretty well done through your process, it's going to take you 2 or 3 years to get your mine up and running and actually producing. So will silver prices still be at these prices by the time or you're just going to build the mine and by the time you finally build it, these are gone. And if it's an earlier stage mine, just 5 to 10 years before it's going to get going. So yeah, there's that whole part. The other quite interesting thing with these is that silver is not the type of mineral that is mined on its own, or very rarely is it ever mined on its own. Most of the time it's in with other metals. And the most common other metals it's in with is actually copper and gold. And so you've actually got all three of them are sort of pushing up there in terms of the prices that you can get. So the propensity for these mines to come on is pretty high over the next. I think there will be a lot of production done in the next sort of a lot of mines started over the next year based on this whole look. We can get the copper, we can get the zinc, silver, gold, whatever it is. All the prices are high. We're going to make a fortune out of these mines, and that will drive this real production boom. So you want to watch for the other end of it. But in the short term, is this a narrative-driven story? Absolutely, at this point. So now it's not about the fundamentals of it. If it was about the fundamentals, you'd be saying, yeah, look, we'll get there. It's not that we don't need that much. But if you're going to have a flood of investors all attracted to it, then could the silver price double from here? Sure. Could it halve? Sure. If it halved, would all these mines still go ahead and be wildly profitable? Absolutely. If you halve from today and you got $45, the miners would be ecstatic. There would be very few mines in the world that wouldn't be wildly profitable at those prices. So it's I don't know if I've helped you with the investment advice, but it's basically we're in this bubble phase now. How high it goes is hard to tell, but I think there's you can certainly see over the next, say, 10 years, the prices of those sort of coming back to much closer to the cost it costs to get this stuff out of the ground and earn a bit of a return on them.
And there are two thematics that came through in all of the sort of waffle that was on social media. Well, the first one, the margin calls. The reason it's dropped dramatically is because people were actually playing the margin calls and trying to actually outposition each other, right? And then the second, of course, is, this is a sign that the whole market is, going to collapse. The US dollar is going to collapse. And then we had the Walsh announcement, and suddenly, no, maybe not.
Yeah, that's right. Well, I do think that was a big part of it, because one of the factors we spoke about with gold, and this sort of applies to silver as well in terms from the investment perspective, is that whole idea of it's the US dollar is going to be weak. We're going to see interest rates are going to be too low. Trump's going to install somebody who's going to just lower interest rates for the sake of it. We're going to see all this inflation, and so you need to get these hard assets to hold on to the value. And I think there's that's a great story. It doesn't sort of work well, historically, what we've seen is when you've got really high inflation, gold and silver often do quite well. But there's been plenty of times where we've had high inflation, and I'm thinking like most of the 80s in particular, where these actually did very poorly. And there's lots of other times as well where they go into these big blow-offs where everyone's trying to protect themselves, and then the other side can be a long, slow decline. So if you'd like to not gamble, but if you'd like to speculate, let's call it, and invest in silver and go and try and get in front of the wave of expectation that there's going to be a bunch more people and we're going to be worried about hard money and all that type of stuff, then do it, but remember that you're speculating and that this isn't sort of the type of investment you say, yeah, okay, I'm just going to grab it, stick it, and forget about it because you can go through decades of losing money on gold and silver. I think there's lots of stuff pointing in the right direction on both of them at the moment, but as we saw last week, you get a couple of the themes start to head in the other direction, and the reversals can be pretty sharp.
Yes. And so that begs the question, if I'm building a sort of an investment portfolio for a relatively long period of time,
Mm.
I may well have a component of metals in it, but I probably need to be a little bit cautious of going all in on metals and saying, no, that's going to be secure, safe, because it will never actually be eroded in value. It'll always go up. If you look at the
Absolutely.
trends in history, there have been times when there have been strong run-ups, but there have also been times when it's come back quite considerably. And the economics, particularly of silver, is very interesting. As you say, at 30 US,
Mm.
you can mine a lot of it if you chose to. So you'd think there would be a little bit of supply demand equilibrium that would pull it back again later, rather than it going off to the moon. Gold perhaps a little bit more likely to sort of hang around because of this issue of it being a reserve. And of course, as we said, the US dollar is perhaps looking a little bit shaky, and therefore treasury is a little bit less attractive. But
Mm.
I'm a little bit nervous
Yeah,
when I see. Go on.
you don't have the central banks. Yeah, you don't have the central banks in there buying, tons of silver.
Yeah,
Mm.
yeah. So I'm a little bit nervous when I see people saying, "Oh, I think I should, sell my stocks and go and buy a lot of metals because that seems the next big." And it's almost like, yeah, there's a difference between speculation and investing. And investing is
Mm.
effectively taking a longer term, perhaps more strategic view, a little more sanguine view. You might miss some of the immediate little spikes, but on the other hand, you hopefully will miss out a lot of the falls and sharing and spreading the risks. Whereas actually, if you do hang your hat on a small number of asset classes or a small number of elements, there's a higher risk element.
Yeah. Now, I'm going to talk about, if you've got a view, say, let's talk about gold actually, just because silver. I'll come back to silver in a second, but let's just talk about gold. If you've got a view on gold that you're like, look, this is, there's all these things going for it. It's still going to go up. It's going to $10,000 or whatever price you've picked on it. Then what do you want to invest in? You probably want to invest in the in the actual gold itself. If that's your views, look, it's going to 10,000, and yeah, maybe it'll crash after that. But whatever. That's what I want to speculate in. If you've got a view that look, current prices are sustainable in the long term, then what you want to be doing at the moment is buying the gold miners, because the gold miners aren't pricing in $5,000, and the silver miners certainly aren't pricing in $120 on silver or $100 on silver, because these are the ones where they're looking at their mines and they're going, well, we can't. Yes, we've got all this gold, but we can't sell it tomorrow. We've got to dig it up first and turn it back. So you sort of get a sort of an average price of that. So in the silver, the stocks, they're probably pricing $30 or $40 maybe. Gold's probably pricing, I don't know, 3.5, maybe $4,000, depending upon what you're looking at. And so if you've got the view that prices are going to stay high or stay close to the current level, then by buying the metal, you're not going to make anything. If you buy gold because you think it's the current price is about right, and that's where it's going to stay in the long term, then you're not getting any you're not going to get any benefit from buying it. But if you buy the gold miners, those average prices are going to go up and up and up as people get used to having higher prices, and the companies keep making the money from it. The other one within the gold sector is interesting, and one of these ones we have a tilt where you can sort of, the way we invest is we've got these sort of core portfolios, and then investors can choose these tilts around it. Is some of the small, the mid-tier gold miners, because those guys actually generally get taken over by the large ones. This is where a lot of the large ones are just they've got all this cash they've been making all this extra money from gold, and they're turning around going, well, should we go and invest in this new project over there, or should we go start up some new gold mine that's not going to be ready for another 10 years over here, or do we just go buy one of these smaller players who's already got a mine that's operating, and we can then expand that mine or industrialize it or do whatever from that perspective. So that's often another way to play this, if you sort of want to try and get if you sort of got a stronger view on these, but without sort of wanting to just gamble exactly on what the metal's doing. Silver's slightly different in that it's actually very difficult to get a company that only does silver. Most of the companies that do lots of other metals as well, and so you don't have the same small cap silver miners. There's a few sort of specialists out there, but largely anyway, even some of the bigger ones you're buying it. It might be 60% silver and 40% other things, and so yeah, there's
Very interesting. And I guess you take a view, right? And I always remind people that people will have different views about where things are going. There is no one single, 100% view of the future. You'll form a view based on your own preferences, based on what you read, what you see, and what you want. And that's part of the flexibility of the platform that you've got. You can actually take your view and you can slant it the way you want to be able to actually take it in the direction that you want it in a relatively easy and transparent way, right?
Yeah, that's right. And I saw a comment up there talking about Labubus and stuff like that that's popping up on your screen.
Yes.
And that's a great analogy though for what we're talking about, because the thing with stocks is when stocks get expensive, you can always make more stocks. Like companies are more than willing to issue more stock at higher prices. They can do that as much as you want. If investors are going to flood the market, there'll be IPOs. There'll be it's exactly the tech boom and what we're seeing in terms of that. That there is if people will pay too much for stocks, there is an unlimited amount of stocks that will get issued to investors until investors are happy they've bought enough. And so for stocks, there's always that basis. It's got to come back to the earnings. You've got to actually see that, what's behind this. At some point, that will bring it back to the right level. The issue with gold and silver is they're on a much longer time frame, and so in the short term, when we want twice as much gold, well, we can't just issue twice as much gold because it's all underground. It's hard to get, and the gold's quite rare, and it's just going to take a long time, and it's expensive to dig up, and so the prices can just disassociate for long periods of time. And the other thing with gold is, there's a whole bunch of us that's been already dug up and is sitting waiting just to we can give it back to people. It's already sitting in vaults if people really want it, but it's more just that hoarding part where people are just hoarding it and you're keeping it. There's sort of that scarcity part in the short term. Silver's got some elements of that, but just nowhere near to the same extent, in that there is just a lot more silver out there. A lot more of it gets used for more normal more normal uses, and it's just much cheaper to dig up the silver as well. And so gold we're talking about as whatever it is, $5,000 an ounce, and production costs of $1,000, maybe up to $2,000 for a lot of the mines. I'm sure you can get some really expensive ones that are more, but that's your typical sort of range of $1,000 to $2,000. In silver, as I said, we're talking about $20 an ounce to dig it up, and most companies are pretty profitable at those levels. And so there is, I don't want to say there's an unlimited amount of silver, but we could double production of silver if the silver price was going to be $30 or $35. You'd get twice as much production online. There's just so much more that can be produced from that. And so there is that, there's just less of a long-term upside. But in the short term, it's not available. We can't get as much silver as what investors want. So you do have that scarcity element. And what's the thing that it will eventually come back to is, well, how expensive is it for us to get more of it? And yeah, I think that $20 to $30 is a pretty good indication.
And just one other question before we move on. Clearly, you can hold the physical metal, or you can pay somebody to hold the physical metal on your behalf, or you can take an interest, or you can take financial instruments against those particular metals.
Or you can buy the stocks. Yeah.
Or you can buy the stocks, or you can buy ETFs. So even if you actually are looking at the sort of the portfolio of different aspects on how to actually access these particular commodities, It's not straightforward, and there are some risks and there are some things to think about in all of those different scenarios. If you take the physical handling costs and the risk of holding it, compared
Yep.
with trusting somebody else to hold it on your behalf. If you've in an ETF, well, guess what? There are fees and charges wrapped around it, whether you like it or not. And if you go for the miners, then you're one step removed, but you've got the risk then of investing in a particular management and team. And so the thing I want to highlight is it's not totally risk free, is it?
No, no, it's not. And I was talking to a client earlier this week who was looking to try and get out of a lot of their silver, that the physical silver that they had, that actually been passed on by a parent. And the issue with that is, well, it's not just press a button on a screen and I'm out and I'm done. It's no, I need to find a dealer, and I need to find a dealer who's not going to take a 5% commission on the deal, or whatever it is. There's a there's depending upon how you want to hold it makes a huge difference. And then I spoke about those companies. If gold goes from 4,800 back to $4,000 over the next 5-10 years and sits there for ages, if you've bought the physical gold, you're going to lose money on that. If you've bought gold stocks, you're probably going to do quite well out of that, if that's where it sits in the long term, if that's the new long-term price. And so, it really does matter how you're investing in these, and what the costs you're paying within each of those mechanisms are.
And of course, if you hold the physical, then you don't get a return. You're hoping for capital movement. Whereas if you invest in the gold miners, some of them will pay dividends and things.
Yeah, that's right. Yeah, the intent is, look, I've got this gold, but they're going to be selling it over time and making that money to then sort of give back. Not they often give back that much money, but they'll be buying back their own shares or buying other companies, and they'll be doing stuff with the money. Yeah.
So my sort of closing point on this one is, there's some things to think about if you actually want to take advantage of this, but also understand some of the risks and dynamics that are underpinning it.
Yes. Yeah. And I think the thing I'd like to leave people with is we're a long way above fundamental prices for both of them, or prices of production that you can sort of see. But could they get even further? Sure, they could. We're in this sort of mania stage at the moment, and it's just hard to tell. And I do want, and we will talk more about this. I do want to talk more about the US Fed, because that is what triggered, in my mind, that's what triggered the big fall.
Well, do you want to talk about the Fed now then? Because there are two topics I want to sort of make sure we cover. One is the whole story about the Fed and Walsh, and then the other is what's happened with regard to the market performance. We've had some results, but I think of the two, the Fed story is really fascinating insofar that at the end of last week we got a name, subject of course to appropriate approvals through the various processes they have to run through. But it did move markets, and it has set up an interesting set of questions about QE versus QT, and about Main Street versus Wall Street.
Yeah. And so, I mean, the big thing everyone was worried about was that Trump was going to push somebody in who was just here to get lower interest rates, to let's run this economy hot, and don't worry about inflation. We'll work that out later. And we've sort of, in a way, we've got somebody like that, but in many ways we haven't. And so that's where markets sort of went, just a minute, this isn't the same guy we thought we were getting. And so that's where, that's where markets have now reacted and sort of gone, okay, he is a sort of a bit of a hard money guy in many ways, in that, is he the type of guy to let inflation get out of control and to say, no, that's fine, it'll all be fine later? Probably not. And that's why we saw, the US dollar all of a sudden a lot stronger, gold, silver. People were worried about the debasement of the US currency, and so buying them, and they had their sudden big falls, because it's like, actually maybe this is somebody who's not going to be debasing the currencies. It's fascinating, the varied parts you get on the views on him. At one end, you've got Paul Krugman, who's a Nobel Prize winning economist, very very much from the left wing side. He's basically saying, yes, look, Kevin Walsh is the ultimate political creature. whenever there's a Republican in as president, he wants low interest rates. Whenever there's a Democrat as president, he wants high interest rates. And so you're getting a political beast, which is what, I guess the markets aren't pricing it like that, but that's what they were probably pricing before that. And, there's some elements of the argument that sort of go back to that. He wanted lower interest rates, but when the whole when the whole financial crisis happened, he was very much that no, you can't do all this QE, and he actually quit because, in part because, he on a sign of protest over the amount of quantitative easing, and that wasn't what the economy needed. So that's sort of one side of it. Another side is, look, he's very much been a contrarian, and he does talk a lot about reform at the Fed, and that there's too much groupthink, and the way they're doing things is not the right way, which is again a good thing in some ways to have a contrarian and somebody who wants to shake things up and change things. On the flip side, he's only one vote. There's another. I guess he has one or two others that might sort of fall in, but it's a big board, and it's full of independent thinkers, and so it is going to be hard for him to sort of to come in with just crazy ideas and convince everyone. It does help as a chairman. You get to stand up at all the different conferences, and you're the one everyone listens to, and so you can sort of meld the board in the right direction. It does also say something, though, that if you're a contrarian, how likely are you to go from being a contrarian to Trump's lapdog and doing exactly what he says? That doesn't seem likely to me. But if Krugman's right and it's a political thing, then maybe he is all for low interest rates. The most interesting part, though, I've sort of left to the end, which is what he spoke about in terms of and what he wrote about in recent years, where he's spoken a lot about that interest rates are too low for Wall Street and too high for Main Street. And what he's meaning there is, it is too easy for banks on Wall Street to take out loans and speculate on assets, and harder for businesses that actually need the loans to get them and actually go out and do productive things with them. And that's the really interesting part for me, because effectively what he's saying is he wants to stop the quantitative easing of central banks out there buying government assets, but lower interest rates at the same time. And so in some ways it's sort of tapping the accelerator and the brake at the same time, but it's in a different way to what we've been doing in the past. And so so if he's going to lower interest rates and at the same time pull back significantly on liquidity within the markets, that can cause some problems, or certainly has the possibility of causing problems. I don't think it's probably going to cause. I don't think it's going to be bad enough to crash markets, in the sense of if it starts causing problems, well, there's a pretty quick and easy fix which they can do almost instantaneously, which is, well, we'll stop, whatever we're doing, and you can reverse it. But this whole concept of saying, well, would I like to see a Fed that, regardless of whether maybe they don't get the answer right the first time or the second time or even the third time, but at least if they're trying to push towards this ideal of saying, we want to make it easier for companies and consumers, or companies in particular, I think the focus has been on, to get loans that are productive loans and can expand. And we don't want to see too much speculation. We want to try and rein in the speculation. That's a great goal for a central bank to have. And, I'm hoping that's not just sort of the lip service or the excuse you needed to get interest rates lower. I hope it is a genuine desire. It's not the Paul Krugman's picture of, he's just looking for an excuse to get interest rates lower and this is the one he's going to use. If it is genuinely, this is his thought process and this is what he's going to try and push the central bank towards, then that's a great thing for the US economy. I've got no idea. I can't tell you which one it's going to be, but it is absolutely going to be the source of my speculation for the next few years, is trying to work out, and you won't be able to work out from any one action whether it's true or not. Whether it's true, I think there'll be some actions where you can work out if it's not true, I think. But yeah, it's the I think for investors, it's probably the one of the most important things to be thinking about for the next few years is do we have a a US central bank now who is genuinely going to try and stop financial speculation?
And that means that it's less likely that the central bank would be concerned if markets slid, because there's always the old Fed put, right? So up until relatively recently, markets have always said, oh, no, the Fed will never, ever let the markets go down.
Yeah,
If
yeah.
if he's got a different philosophy to say, no, 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 actually, maybe
Well,
markets are overvalued, but that's not really where the action should be. It should be the impact for real people and mortgages and everything else. It changes
yeah.
the game. Although, of course, the 30-year mortgage rate is driven off the 30-year bond, which,
Off
of
the
course,
Fed.
is
Okay,
linked to the
let's come back
markets.
to let's come back to that one. Let's come back to the 30 year because that is very important as well.
Yeah.
Okay, so but it's an interesting thought there. What you're saying, is the Fed put lessened? Maybe. I guess it's this question about look when you say you're like when you say I want to rein in Wall Street, does that mean crash it? I don't think it means crash it. I think it means let's make sure that going forward they're not pumping liquidity and they're there to yeah, it's an interesting question. I don't know if I've read enough of him to my guess anyway, even if look, I don't think Krugman's completely right, but I'm sure he's got at least some element of yes, he's a Republican guy and he doesn't want to crash Trump's economy for him.
Mm.
Is that he'll be like, yeah, I want to rein Wall Street in. I don't want to crash it. It's a bit like your general. If you're in Australia and you're with your housing prices, you're like, well, I really don't want house prices higher to go dramatically higher, but I don't want the market to crash because I'll lose my job forever and everyone will hate me. So maybe if I can just make them go sideways for a bit, I think could be. I
So,
suspect it's more like that.
so my question, I don't know the answer. My question is that question of the Fed put or not actually is a
Mm.
pivot question in terms of actually
Yeah,
laying thoughts for the future, right? And we won't know
it's
for some
where's
time.
your safety net?
Yeah,
Yeah, do you have a
spot
safety
on.
net still? Yeah.
Exactly. Exactly.
Yeah, and but the reminder as well that you know when Powell started, it was all bang bang market. We're not here to I'm the new sheriff in town, and we're not here to bail out markets. And then markets promptly fell.
Yes.
And you know what? He was there to bail out markets.
Correct. Exactly
And I was
right.
just and so I guess what I'd say as well is that's your trading idea, and certainly the way I'd be looking at it is that if markets decide to test him out and do start tumbling to looking for the Fed put, and you know, and he does backtrack and flip and then go, okay, well maybe I am here to back up markets. That's a good sign to buy. That's your if markets take that tumble, jump in with both feet at that point. I think is would certainly all else being equal is certainly be my plan. Is that yeah, one more like that. Okay, 30-year mortgages. Let's not leave that because that's the really important thing with the US is that uh, so in Australia, if you're running this as if you're a central bank coming in with that, you've got room to do this. And yeah, look, if the 30-year government mortgage or sorry, government bond rate goes up, it's like, oh well, it goes up. Everyone borrows at the short-term rates, and so that's what we're influencing. In the US, it's not. Yeah, the US, everyone borrows at the 30-year mortgage rate. And so if you get this part where he's trying to make it easier for Main Street, harder for Wall Street. Well, companies borrow at the shorter end. They don't borrow at the 30-year end, but consumers borrow at the 30-year end. So it's just part about okay, I've made my loans cheaper um, for my companies. If the market takes the view that this is going to be inflationary and it's going to be and so long-term growth expectations, so long-term inflationary expectations go up, then you're right. Mortgage rates go up, slows the US consumer down, and so they don't have as much control. Is there an element where he could do I do think there's probably some element where he'd do curve control, where it'd be operation twist in terms of it wouldn't be quantitative easing, but it might be saying, well, I'm going to be buying the 30-year and selling selling the 1 year. I think I think they do have a lot of capability to do that. And then the other one is, was going to talk about this is, oh, look, we've already got, Trump browbeating Freddie and Fannie, which are the two main sort of government entities or quasi-government entities out there making loans, pushing them to try and get loans lower. And I do think there will be that, that focus. I think there's other things the Fed could do around that, and that would fit with what he's said. He's not quantitative easing. He's neutral and just changing the shape of the curve to make it easier for consumers, or whatever rules for consumers to make it easier for them to borrow.
Yes, absolutely, and we're going to keep an eye on that, of course, because the bond trends are quite interesting. In fact, the 2-year in the US at the moment, which is what this one is, you can see it's knocking around 3.588, but actually, if you go back to September last year, you can see that it's come down from where it was. It was 3.95 back in August, and it's been going up and down, up and down, up and down, but hasn't really gone anywhere much. And
No.
going back to your Operation Twist, of course, what the Treasury in the US is actually doing is actually getting rid of some longer-term bonds and buying short-term bonds because of that differential in the two rates at the moment.
Yes. Yeah, and that's where yeah. Anyway, I think there's fascinating. So where we? I think we're kicking off in April. I think it is. And look, the thing is, he's not going to. It's not like he's going to get there and go, right, I'm the new president of the board. This is my thing. This is what we're doing. He's going to have to get there and go, right, this is what I want to do. Let me start working around it. Let's, what do you think's good for this? What do you think's bad? Here's the goal. Here's the new goal is let's get it easier for Main Street, harder for Wall Street. And negotiate with people around what are the things they can do. And so it's going to take months of work.
Yeah, and I think
sorry. And the other interesting one is Powell staying on as well.
Yes, anyway, yeah. No, well, I was going to just pick up that point. So the other interesting thing, of course, Powell has the potential to stay in the board, if not as the chair, as it were, for quite a bit longer. So that's going to be an interesting little journey as well. Yeah,
and he's basically been stonewalling when people ask is he staying on or not. He's just like, oh, I'm not going to deal with that. So I think I do think in a way Trump's actions have probably backfired on this. I think if Trump was keen he's probably trying to get him just to move interest rates lower, I think, initially. And then when he didn't, he went all out on this. I suspect that I think he probably will stay at least to the next president. Assuming elections do go ahead and everything like that, is that he'll probably hang around and to a different president, and so that he can with a view that the sanctity of the position and the importance and having a considered view as to who's going to get through. And I know you spoke a little bit about Walsh does still have to go through the nominations process. I don't see that being an issue. He's already been on the board. He's actually a pretty reasonable. Of all the people it could have been, he was one of the front leaders at the start because he made the most sense at the start, and Trump sort of looked at a whole bunch of other people, and in the end came back to all the reasons why he looked like the best candidate at the start were the reason why he ended up getting the job, and so. I don't think there'll be any major issues because it's not like he's coming in with as a complete novice to this.
Well, in fact, he was the candidate last time, but Powell just won, right? So he's a known quantity, and I don't know whether the selection process and validation process will get politicized even more, but probably not. This is it's an interesting, but the point I want to make, and you just to underscore, this is something to watch because it can fundamentally change your thoughts about investment strategy and portfolios and all of those things, not just in the weeks ahead, but in the months ahead.
Absolutely, and that was, the reactions from the market. I mean, we saw a bit of reaction from the stock market and the bond market, but not really that much. It was really the silver and gold where you saw the most amount, which was, the fact they were in a blow off. They'd risen so exponentially. It was going to come down at some point, and they needed the reason. So it was partly that, but it was also the bigger part was more that, who is in as that Fed governor. If they let inflation get out of control and they don't sort of, defend that, that makes a huge difference. That's the most important thing for investors for the next 20 years.
Yep.
And so knowing that you've got somebody who's not going to let inflation get away, that's what I think the gold and silver were telling you when they fell so sharply, is that, look, this isn't just somebody's going to do exactly what Trump says and just let inflation get out of control.
Well, let's move the conversation forward, because we have started to see the results now, both in the US and a few other markets too. Not completely through yet, but what are we seeing?
Look, they're pretty good. So looking at fourth quarter numbers in the US, there's definitely been some numbers that haven't been as good as what the market has wanted. I'll talk a little bit about AI because it is important sort of sector in a minute. The earnings themselves are good. So the fourth quarter numbers look like they're going to come in around about 10%. The forecasts for next year have been pulled in slightly, but it's been pulled in from sort of 15.8 or something like that back to a little bit under 15.5% growth. They're pretty spectacular growth numbers. I've got a chart up. I might just show if I can, Martin, over the last. This is the last 20 years. Yeah, last 20 years-ish of US company earnings. So each of the lines is the forecast for that particular year and how it sort of went over the time. And you can see that most of those, that's all the blue lines. And then the red line is the average 12-month forward number. And so you can see those blue lines tend to go down. So what tends to happen is analysts come in with a forecast, it's a bit too high, they tend to come down, but actually, they go from being, if you bring in a forecast from 10% and it comes in at 6%, it's like, well, we still got 6% growth. That's pretty good. 6% growth plus a 3 or 4% dividend, you end up getting a close to a double-digit return. The interesting part I want to draw you back to is the very last two lines, which is your 2026 and your 2027 numbers. They're still going up. It's forecast. The forecast is at the moment, like that red line. If you look at that red line, which is the weighted average, it's now roughly as steep as what we saw coming out of COVID. It's steeper than what we saw coming out of the financial crisis. It's going up at a rate of knots. So the numbers at the moment in the US are forecast for over 15% growth for the next 2 years, which is spectacular growth if we get there on it. That'll give you 30% onto your earnings. So if prices didn't go anywhere and those two roll through, is you sort of going, well, that brings your earnings in from 20-ish times earnings. You knock 30% off that, and markets are starting to look cheap. So that's sort of the key to me. This is the key to markets. If that number turns, and we stop seeing those upgrades, then that's when you have to get worried, because expensive markets are fine while you've got good earnings growth. Once that earnings growth turns, that's when the wheels can fall off. And so, very much keeping a close eye on that. The AI growth, what have we seen from AI stocks? Look, Microsoft's certainly disappointed, but in a way, it's hard to know where. Look, I don't think I'm drawing that through to the rest of the market. In a way, that's a little bit of a reflection of OpenAI, and that Microsoft is relatively close to OpenAI, and OpenAI, they're sort of they're on the fade, whereas some of the other ones are still rising. It was a mixture of higher capital expenditure and lower earnings. I think that sort of hit Microsoft on that front. And so I think there's still certainly signs that the money is being spent out there. The questions on the returns, I don't know how much I want to read one quarter into the returns that they're going to get on AI and selling AI products. And so, yeah, I'm still like the capex plans are still there. I'm not, you know, there's you're always got to treat these things with respect when you're seeing changes in these. But I still haven't seen anything that's groundbreakingly different to I guess expectations. This was more a bit of a mix of capex was a bit higher, revenues were a bit lower. The stock got smashed on that. But we've seen other positive ones come out from other stocks.
Yeah, Facebook, for example, very positive, and they're also
Mm.
investing big in AI too, and even a few of the other ones, the Googles of this world still going up. Amazon looking pretty strong too. It's worth, I
Mm.
think, highlighting the fact that Oracle just have recently announced that they were actually going to issue more bonds to be able to actually fund even more investment in the AI story. And
Mm.
Oracle, I suppose, is an interesting example of an older style organization trying to morph itself into an AI story, right?
Well, yes, yeah, yeah. I treat Oracle as being they got lucky. Now can they turn that luck into something different? And I think there's a reasonable shot. They have a reasonable shot of it. And what do I mean by they got lucky is that the asset they really owned was a whole bunch of engineers, software engineers, and hardware as well that know how to set up data centers um, uh, and systems around it. And so they've got all these engineers. There's this massive AI boom coming, and all of a sudden everyone needs data centers. And so they've basically flipped from going, okay, we're out selling our own databases to actually we're gonna set up data centers for other people and run them for them. And so the question now is, can they, they're very much at the pointy end of this boom. Can they turn that into a new business similar to how NVIDIA did? So NVIDIA went from being the, having these great GPU chips that you could use on gaming machines to all of a sudden these chips are actually needed are really good for doing AI to building out an entire ecosystem around that. So I do think Nvidia got lucky, but then they turned that luck into a completely new business line and really drove it forward from there. And so Oracle has that opportunity to do this to do a similar thing. Now, will they do it? I don't know. Some of the benefits behind it are that Oracle's in a spot where they're one of the few big players in there that aren't competing with either their customers or their suppliers. And so, there are some benefits to Oracle, but they are literally, adding a zero on the end of their earnings in that one division over like a year or a year and a half or something. And so, can they do the same again, or they don't even need to add another zero? They just need to, maybe they only grow up by 3 or 4 times more, and they could be a serious player in that market. I don't know if they'll get there, but I think it's one that I'm watching very closely. Let's put it that way, because I do think it's a Rorschach test, as I've been saying on Rorschach test on the AI boom in terms of is it something that's going to last or not?
And I showed you that the price went dramatically up and has come a long way down. So if you believe that they've got a story that's compelling, then it doesn't look overvalued at the moment. So it's a fascinating.
No, it's much more reasonably priced than it was a few months ago. So
exactly.
Exactly. It's a question now of can they So now you can sort of buy it at closer to what you can buy Microsoft's and Amazon's at in terms of multiples. So.
And in terms of balancing the US versus other markets, the US is a huge market relative to everybody else. The Trump tariffs hasn't shaken things as much as people expected. The results are looking quite strong. AI is there, but other sectors of the market also doing reasonably well too. So is the US investable?
Yeah, it's investable. And I think as well, the other thing to keep in mind that has been holding up earnings a bit more than I think what most people will admit is the US dollar's been pretty weak. The US market, certainly at the top end, is dominated by multinational companies. When you buy most of the S&P 500, there's not that many purely domestic US stocks in there, particularly at the top end of it. And so when the US dollar is going down, actually their earnings are going up because their international earnings are going up. And so what they're reporting back in US dollars can sometimes getting that can sort of can flatter the results a little sometimes. So from my perspective, if you're buying multinationals that are invested in the US, then I definitely don't have as much concern. Uh, if you're buying purely domestic US stocks, then you just need to be careful that you're not in a sector that is going to be hit too hard by if you do get the downturns. And a number of the purely US ones, are suffering more than the multinationals.
Yeah, okay, very interesting. Now, I've just got to go and take a delivery from the door. So let me throw a question at you, and then I'm going to let you
Mm.
talk for a moment to see while I go and sort myself out. Um,
Yeah.
the issue then is not just the strength of the dollar, but the relationship between the dollar and other currencies. And I'm thinking particularly of Japan, and I'm thinking particularly of the Aussie. How do you unpick that as part of your investment portfolio?
Yeah, definitely. And the big issue we've got at the moment is around the Aussie dollar versus some of these other currencies. Now, the question is the Australian interest rates higher and the Australian and inflation higher because the Australian economy is way stronger than what we're seeing overseas in a lot of the other countries? If so, there's more of a reason to have your money in Australia. And the question is, do you want to hedge some of your international holdings and things like that? The other question is though, how much of what we've seen has actually just been a lot of it's been US dollar weakness. And actually, if you look at the Australian dollar versus, say, the euros or pounds, depending upon what your timeframes and everything like that, then all of a sudden it doesn't look as strong. And there's certainly been periods where the Aussie dollar has actually been a fair bit weaker than some of these other currencies. And so there is this sort of fine tuning about, how much have I got invested in the US and how much that's expensive. Have I got the right stocks that are multinationals anyway that just happen to be invested in the US, and so currency's not as much of an issue. And then how much have you got in Europe? Now we've certainly had a lot more in Europe and Japan over recent months, and that's sort of very much aided in with our performance has been very good over, relative to others over the last few months, and well certainly over the last year as well. And a lot of that's been driven by that decision, but now there's this, the thoughts on the Fed and what are they doing, and are interest rates going to be falling there while they're being risen in Australia? It all comes back as an important decision to make in terms of your investments. And I guess what I'd like to just highlight for anyone investing overseas is that the Aussie dollar is a pretty good shock absorber when you get problems. So if you're an outsider, if you're sitting in the US investing in Australia, it actually makes everything more extreme. So you look at an investment in Australia as this high risk investment because if stocks go up, the Aussie dollar often goes up as well. World growth is strong, so commodities are strong. The Aussie dollar goes up, and so you get sort of double the return. So if I'm sitting in the US investing in Australia, I got a 10% return on my stocks, and I got another 10% return on my currency. I turned it into 20. The issue is when you're an Australian investor investing out, it's actually the opposite. When things go badly, often you see a stronger US dollar, and so what you often that turns into a bit of an offsetting effect. And so what it means is over a longer period of time, you tend to get a better risk return, a risk adjusted return as an Australian investing offshore because similar types of growth, or the growth has actually been a lot higher in recent years, but the volatility, so how much it bounces around, ends up being lower. And so, we still quite like that outlook. We're still going through the thought processes around. So we've been very much invested more in Europe, more in Japan, and less in the US. But within the US, sort of very much trying to pick out those large AI benefiters within that. And so now we're starting to rethink though. There's as I think most people should do, is to, what is the right weight? How much a Fed's going to affect currencies? How sustainable are these interest rate rises in Australia? Where I think in our view, the Australian economy is a lot weaker than it might look, and that and certainly the company earnings in Australia has been a lot worse than what we've seen overseas. And so there is a timing issue about when do we think the top of the Aussie dollar is in, and when will we start seeing the weakness. And certainly by the end of this year, I think that'll be the case. The question is it in a month or two, or is it now, or is it in 6 months? And at that point, we're sort of starting to flip more so into US stocks, I think, and more out of Australia, or unhedging where we've got hedged positions.
And I think that's the point. This isn't a set and forget, is it? You've got to sort of take account of the evolving dynamics and the relativities, because of course it is all about relative risk, relative returns. And I do think the exchange rate story is a really interesting one. As you say, it does insulate to an extent. I suppose the other question is, what about black swans? Because people are always worrying about, will they reprice the gold that they hold in the US, or, will some other thing like the stablecoin thing, will that actually rock the boat? And there are a lot of people spending a lot of time and effort talking about all of these potential black swan events. I've lost count. I don't know how many black swans are flying around. There's quite a few of them whizzing around. How do you
Trump's liable to create more of them?
Yeah, well, exactly. So how do you deal with those? I mean, do you just sort of say, well, yeah, could happen, but relatively, it's probably unlikely. So, or do you always say, well, if I got to keep an eye on that, because if it does happen, that's significant. I mean, that's for me one of the big challenges of trying to work out how to actually build a portfolio over time in uncertainty.
Yeah. So look, there's two parts to this. One is how localized are the problems we're talking about, and so there could be problems. And let's take silver as a good example. Let's say the silver price went back to $20 tomorrow. So it falls from $85 back down to 20. It's whatever it is, a 70% fall or something like that. Now, if you're invested in silver, that's pretty devastating for your portfolio. If you've got lots of it within your portfolio, it's devastating for your portfolio. As a global economic outlook, look, the silver market's pretty small. It's really not much. It's really just not a meaningful thing. Is that on its own, is that gonna disrupt the entire global market? No, it's not. So you can sort of look at something like that and try and put that into how much danger is it, and where can it go. If you look, say, at something which we consider a bigger issue, say the amount of private credit out there and the issues around that, if you started to see some ructions in that, that's now a much bigger and much more opaque market, and we would be more likely to be, shooting first and asking questions later. I think there's it's sort of trying to assess how big is this problem. So now, if private credit, if it had been 10 years ago and there's problems in the private credit market, it would have been like it's not that big of a market. Yeah, it might be cause some problems around the edges, but it's not something that you'd sort of look at and worry about. Could this bring could this bring a whole bunch of other things down with it when it goes? It's getting to the size now. Private credit is one of those areas that's getting to that size. Issues in private equity are another area we keep an eye on in terms of what's happening in terms of that. I don't think. Emerging markets. There's always going to be an emerging market blowing up somewhere or other. I don't think there's not as much exposed to that. I think we've had a few quite significant events in emerging markets. So Russia, basically getting kicked out of the financial system a few years ago was a significant event. And I think there's that when you get those sort of warning shots, it's unlikely that 3 or 4 years later, another country, exits the sort of world order, and all of a sudden nobody expect that could ever happen. It usually takes a while of everything being great before people build up those. And so it's rarely the events that we've just seen. And so that's one of those ones we spoke about. I can't remember if we had the Japanese bond thing. I feel like that was in the last month. I don't think we spoke about that last time, did we? But this idea about these Japanese 30-year bonds rising quite sharply, could that have could there be a bunch of people out there who had just leveraged their portfolio in the wrong way, and the next thing that's blowing up all these things? Look, maybe, but we sort of had a dry run with the Liz Truss moment in the UK a few years ago, and everyone got to see, all these funds that had taken the wrong bet, and all of a sudden they were going to be illiquid and they needed bailouts or more liquidity, and that could have brought a whole bunch of the system down. When that stuff happens, people sitting in Japan going, just a minute, we've got a similar position on Japan. Should we maybe work about what are our risk limits? And they go through that thought process. So I guess where I'm trying to get to is the black swans you should be worrying about are the black swans where things have been good for a long time, like private equity or private credit, and there's the potential that things won't be good and it'll blow up. It's very rarely the ones where you've already had one, you've already had this thing, and that's another good example is the U.S. commercial property. So we had that shock, a few banks fell over and everything like that. 2 years ago, I want to say. I don't know whether that's right, maybe three. And so because that happened, yes, there's still problems in that US commercial property, but is it likely to bring all these things down? No, because everyone's seen the problems and had a chance. We've had a couple of years now to sort out whatever the issues you might have had around that. And so, the next set of problems are unlikely to be, there's unlikely to be a black swan event that blows up a bunch of things, stemming from that. So that's one part. The other part, and we've spoken about that this plenty of times on the show, is that central banks have this fire hose of liquidity, and they're very willing to use it. And I feel as if 20 years ago something would happen, a bank would fall over or something like that, and they'd be like, oh well, let's see what happens. These things happen, banks fall over, let's just wait and see. And if there's problems, we'll write up some white papers and think about what we'll do and vote on it, and in a few months' time we'll do something. Whereas nowadays they seem to be, oh, there's a problem. 3 days later, markets are struggling. Bam, here's this fire hose of liquidity. Have this and move on to the next problem. Let's make that a problem for another day.
Yeah, and I think you can get over fixated on trying to sort of corral the black swans and what if, right? And I sometimes get the sense when I'm chatting with people that they think, well, maybe today isn't the day to invest because there's risk, that, and of course a year later, maybe I won't invest today because I've got this risk. So sometimes feet in market and just roll with the punches rather than actually trying to sit outside the market saying, well, one day I'll get round to it.
Yeah, that's right. So there's they call it the wall of worry, and markets climb a wall of worry, and that's always the case. There's always a reason to sell markets. You can, there's, if I'm selling an investment newsletter or, it's much easier to sell an investment newsletter with either, boom or doom. And so, it's either that everything's going to the moon or everything's about to crash. That's a way better story than, yeah, look, it's one of those ordinary times, and there's more risks about at the moment, and there's to have a more moderate view. And so, I just keep coming back to those. How big is the market we're worried about in this case, and how much damage it's going to do, and then how many signs are in that market that we're having problems? Because most of the time, when I read those, it's like, here's some small part of the market that on its own is not going to do anything, but it could be disastrous for that part. It's like, fine, it could be disastrous. It's not going to bring everything else down. Or it's like, here's some big part of the market that's actually showing no signs of cracking, but could crack in the future. And that's one. It's like, yeah, sure, okay, I need to keep an eye on that, because if that cracks, it's problems, but it's not showing any sign of cracking. Okay, I'll make the assumption it's going to keep going until it doesn't.
And that's why diversification is so important, isn't it? If you put all your eggs in a basket or two baskets, and one of them goes wrong, that's big. But if you've actually got a diversified portfolio and you've actually deliberately built it in a way that allows you to have these checks and balances, you're going to be able to actually weather through. I mean, I've seen significant crashes. I started investing in the 1980s, right? And so I've seen a number of significant drops. and significant black swan events and things. But you're still hanging on there because actually over time, up to the right is ultimately where you end up.
Exactly. And the thing I take out of that sort of 20, 30 year period is you go, what were the really big events that you did need to make some big changes? Okay, the tech boom.
Yep.
Look, there's a boom going on. There's crazy prices being paid. We knew that there was going to be a problem. It was unsustainable and it needed to crash at some point. It was a question of working out, riding with that until you saw, okay, we're starting to get to the stage. This is all really crazy, and when these IPOs stop going, I need to clear out of this stuff. The financial crisis, similar in terms of the amount of lending and the amount of problems that were all within that housing market were all pretty clear to see, and that this was unsustainable. You don't get that type of housing price growth. You don't get that loan growth. Go on forever. And it's a question about saying, well, yeah, but you could clear out. You could have cleared out in 2003, going, oh, this housing market's terrible. It's never going to save. But it's about saying, well, no, if it's all pushing through in that direction and there's no signs it's all going to fall, that's the thing I need to keep watching. When it does show signs of cracking, now I need to clear the things. The COVID was a bit different, and obviously a lot shorter and sharper. Yeah, for me at the moment, AI, we're watching. Does that get crazy? Those earnings that we're watching, if those earnings start dissociating and stop going up, we need to be concerned. And then where are the debt parts we should be worrying about? Private credit, and I do think there's some private equity stuff as well, which that market's grown far too quickly over the last sort of 10, 20 years, and I think there's a lot of stuff that would have ordinarily been public equity. And there's a way as well that the private equity works that they can sell off all their good assets first, and then they're left with all these bad assets, and so everything looks really good because they're making all these great profits on the initial ones, and then it's all the junk at the end they couldn't sell that eventually needs to end up in the bargain basement. And so and there's a lot of debt's been taken out around that, so sort of related to the private credit bit as well, but it's an area which those are the big ones I'm worried about. And then obviously there's Trump. What's he going to do next? He could break a lot of stuff, but that's assuming there's the taco trade, the Trump always chickens out is a reasonable assessment, I think. So at some point he won't, but it is worth watching for what he's doing more so than what he's saying.
And it's worth just reflecting on, if you look at where the tariffs were expected to be in terms of what they were going to generate and what they actually have generated. Well, they've generated some, but it's nowhere near as high as it was expected to be. So that shows you that maybe words and figures can actually differ sometimes.
Absolutely, yes.
Well, Damon, we've come to the end of the show. I think I've covered all the things that I wanted to cover, unless there's anything else that you want to highlight before we finish.
No. I think that there's probably three. I think we've done 1 week of the 4 weeks since we last spoke. We managed to get Japan in there, but I'm sure there was a bunch of other things we've missed, and hopefully it won't quite be as exciting over the next month, but I suspect it will be.
I think we're going to continue to see this volatility and a lot of uncertainty. But the point is, signal and noise. It's really, really important to discriminate the two, right? Because
Yes.
if you get caught up in all the noise, you're going to miss the signals, and it's actually the signals themselves that are really important when you're thinking about investment, when you're thinking about decisions that you're going to take in terms of protecting your future and all those things. So I always say, use the discriminator. Put
Yeah.
signal and noise
And-
ain't the same.
And a regular investment plan is, if super is great in that the money goes you don't make a decision, just keep going in every month or every fortnight, whatever you get paid. If you're doing other investing, try and do it on a similar way, because at that point you're going, if I'm regularly investing, you know what? Sometimes I buy a little bit higher, sometimes I buy a little bit lower, but it's that regular investing is way more will get you somewhere. And for people who are concerned about this, we spend a long time talking. The coaching side of what we do is basically saying to people, you need to set up as the default is you'll become invested, and you can always stop that. But don't let the default be, I'm going to sit on the sideline and keep my cash piling up until one day I feel like all the stars have aligned, everything's perfect, I'm going to make a fortune by piling all in at this point. You're never going to get that day. You're far better off having that consistency, and that your default is you'll keep investing and keep growing that, and then pull it back. That's 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 your exception rather than being the other way around. Is the default is I don't invest, and then every now and again, exceptionally, I'll stick a bunch of money in.
And the magic of dollar cost averaging, right?
Absolutely.
Yeah. Damian, thank you so much as always. We'll put links and things below for those interested in what the world funds and Nucleus wealth, and we'll hopefully get you back next month for another exploration of at least a week.
Yeah, thanks a lot, Martin. Great to see
Okay,
you
take
again.
care. Cheers. Bye-bye. There you go. I hope you found that fascinating. I certainly did, and Damon's always great value, and look forward to his next conversation. Thank you so much, Jason, for your super chat. Really appreciate that. Certainly helps to pay the bills, so thank you as always. And I want to say thank you for spending some time with us this evening. Next week it'll be me, and I'll be going through some of the latest modelling and particularly some of the household analysis I've been doing recently. You may have seen the articles over the weekend in the newspapers, thenews.com and other places. There's quite a lot going on there, and I've got some information to share next week as well. So doggies are here. Yes, so we can look at the dogs. There you go. The dogs are here. So that's now the next task, walkies and that sort of thing. But thank you very much for spending time with us this evening. Take care. Have a good week, and we'll see you next week. This is Martin North from Digital Finance Analytics signing off. Take care.